Sure.
Good day, everyone. This is Shani Beauty Korea. So we are here to actually um, take this article of this topic, which is partnership. So in partnership, we will look at the definition of partnership. We will look at the changes, the various changes in partnership structure. So from there, we will consider how to prepare the final account of partnership. So right now, we go through what defines partnership, the first leg of partnership. So we look at various types of partnerships, various types of partners. Then we look at the deed of partnership, then the accounts of the partner. So just stay with me as we actually pass through all of these legs. So the first thing we have here now on the screen is to actually talk about what defines partnership. So we bring by the common definition of partnership. Partnership is defined as a relation that subsists between persons in common with the view of profit. So as I say, it is a form of relation in which so much people come together in order to one way or undertake economic activities for the purpose of what of making profit. So it is a relation that subsists between persons in common with the view of profit. It is a relationship in which two or more persons come together to provide the necessary finance and oversees the formulation of the business enterprise with the common aim of what of profit. So when so more people come together to actually establish a business enterprise with the common view of making a profit, we have the light of partnership. So there are many forms of business where people believe that okay, they can actually establish business, stay in business with the middle aim of having to derive profits from such establishment. So and although in most instances of partnerships, we have 2 to 20 persons, and although the law may allow having more than 20 in some content, and not having more than 10 in some content. I think in the aspect of professional content like accounting firm, the legal firm and all those things like that. I think the common number of partnerships there is around 10, not exceeding 10. Now, why in some countries the law can allow having more than 20 in such establishment. So, we have to talk about is the point of partnership deed. So, in partnership deed, I said it is a document that contains the necessary rules and regulations that is necessary to guide the act of partners in partnership. So, we're talking about partnership deed. We're talking about there will always be a need to have a detailed document that is needed to guide the actions of every partners in a partnership. Because why? If partners are not guided by laws, by rules, what happens? Partner will be feel that they can act as they like and or they can ask anyone, which will not be the one way or the other beneficial for the whole partnership business. So there will always be a need to have a guiding rules in one way or the other that will guide the actions, the behavior of partners in the partnership. So for those that are the people in the partnership business and the partners, so there will always be a need to guide their actions. So the document that the one will define those regulations, the act and action of the partners is called partnership deed. So what are the things that we usually have in the content or that define the content of partnership deed? Or what does partnership deed actually contain? So partnership deeds will contain the names of the partnership business and the names of the partners, of all partners. Yeah, to contain, what is the name of the business, what is the name of all the partners that are available in the partnership. It should be divided in the partnership deed. Also, the partnership deed will contain the ratios in which the profit or loss of the partnership is to be shared among the partners. So how are they to share the profit, or loss in the period? Because profit or loss are usually being shared by the partners in partnership. So the interest to be charged on partners join will be defined as well in the partnership deed. So what amount of interest is to be charged and every other thing. The interest to be allowed on partners' capital will as well be defined. The signatory to the account of the partnership as well will be defined. The basis for which the admission of a new partner will be defined. Also, the basis for termination of the partnership business will also be defined. Interest to be what? To be offered for any partner loans. So these are the common aspects of the deed. So a deed usually contains all of those information. The names of the partnership business, the ratio in which the profit or loss of the partners is to be shared, the interest to be charged on partners' drawings, and as well the interest to be allowed on the partners' capital, the signatory to the partnership account, the basis for the admission of a new partner, the basis for the termination of the partnership business. All of these are what is usually contained in partnership deed. And we have many more that are usually defined by law, but these are the most common ones in the content of the law, or what we usually have in the partnership in most deeds. These are, although some content might actually varies or might be peculiar to a particular partnership business, but these are the most common aspects of every deed in most partnership. The next thing we have to move to now is on the point of rules in the absence of the partnership deed. The laws have it, or partnership plan have already have it defined. In the absence of any law in the partnership business, the rule that works are these rules that we are about mentioning. For instance, whenever partnership fails to actually have an agreement, because the agreement is to be defined in the deed. So whenever there is lack of agreement among the partners in the partnership, or there did not reach any agreement, defining agreement in the deed, what happens? The Partnership Act actually having that this rules is to actually operate. And what is the rules? Well, what is it? The common rule is just that everything that goes on in the partnership has to be assumed equally. For instance, the partners' profits, the partners have to actually have equal rights in the partnership. All partners in the partnership business will have equal rights. So there is to be assumed that this partner A have same rights as partner B. So as far as the partnership business work is concerned, there is no partners that have greater rights than the other. So these are the defining rules in that manner whenever there is lack of it. So we have the profit of the partnership be shared equally. Yeah, it's very simple to grab. The partners have shared their profit equally. There is no interest to be charged on drawing. So if any partners in one way or the other withdrew from the business, the drawing will be withdrew at no cost. That is one thing I want us to know. It should be at no cost in one way or the other. Also, another one is that there is no interest to be allowed on partner capital. No interest on partner capital. Also, there will be a fixed rate of 5% interest to be allowed on any partner's loans. That will mean if any partners give the partnership loans, that loan is to attract a fixed rate of 5%. And this is the most asked questions in partnership. So I really want you to get yourself familiarized with this aspect and get yourself used to it, because there is no special thing. So no interest on capital, no interest on what? On partners drawing, no interest to be given on partner capital, that is true. There is no profit is to be shared equally, profit is to be shared equally, and as well, there should be a fixed rate of interest of 5%. These are the most common rules that actually operate in the absence of partnership deeds. So next thing now we have to talk about is actually the types of partnership business. Basically, we have two main types of partnership business. So we have the ordinary or general partnership, and we also have the limited partnership. So in the ordinary partnership, partners in that partnership usually have equal rights. Yeah, they have equal rights. But one common feature in that general partnership is that partners do not have a limited liability. That means they have unlimited liability, meaning that partners can be required to bring in their worth to pay the debt of the business in the instance of liquidation. For instance, if the business comes to an end today and it requires bringing a lot of money in paying of the debt, partner will have to be required to bring their personal wealth, their personal property. They will have to be able to pay the debt. That is just the overall idea of ordinary and general partnership. So you also have the second part here, which is the limited partnership. The partnership rules here actually rules that the partners in that partnership do not have equal rights. Let's take note of that. They will not have equal rights in one way or the other. But as far as the partners are concerned, they have limited liability. But there is a governing rule that says, as far as these partners are concerned, there must be at least one partner that will have unlimited liability. The rest cannot have limited liability as far as that is concerned. So, as we can see, ordinary or general partnership, partners in the partnership have unlimited liability and have equal rights to all activities of the business. While limited partnership, the partnership rules require majority of partners having limited liability, but there should be at least a partner with unlimited liability. So these are the governing rules that work. These are the two main types of partnership, that can be operated for whosoever that is to establish partnership business. So next thing now we quickly consider is types of partners. We have different types of partners. We have different types of partners that actually was available. We have general partners. General partners are those partners with unlimited liability and have full rights to the partnership business. In fact, we can call them unlimited partners because majority of general partners usually have unlimited liability. But one governing rule is that they have full rights. Is that okay in the partnership business? Active partners are partners that are involved in the day-to-day management of the partnership business. Like they take full actions as regards to the administration activities of the partnership business. They are always available. So we call them active partners. Like they are actively involved in the overall activities of the partnership business. That is one special thing about them. Also, we also have the dormant and passive partners. So these are partners that do not take part in the administrative activities of the partnership business, but they usually provide capital. But they do not take active part in the partnership. So partners that do not take part in the administrative activities of the partnership but provide capital are called dormant or passive partners. We also have the nominal or passive partners. Partners that neither provide capital nor take part in the management of the partnership but share in the profit of the partnership. And this is because such partners provide their name, they provide their goodwill, they provide their reputations, and those original partners believe if that partner name is included in the partnership for management of the business, the business can achieve more. The business can achieve, can grow quickly. So that's why they actually using that name. So dominant partner or passive partner just includes or provides his or her reputation to the overall management of the partnership business in one way or the other. So Partnership Act provides that such partner must contribute towards meeting the partnership debt in terms of liquidation. Meaning, if the partnership is to come towards an end today without then the partners must, in one way or the other, such partner must also contribute in meeting the debt of the partnership. We have limited partner with limited liabilities in one way or the other. That is what defines limited partners. We also have the unlimited partner with unlimited liability. I think that is a little bit straightforward and it's not in any way confusing for us. So with capital maintenance, I think we are about entering what we need to know for the purpose of calculation. Because we don't know this, our calculation might not go as straight as expected. So we really need to have a good understanding of this aspect. So what defines capital maintenance is just how does capital manage and maintain, how does partner rather manage their overall capital. So partner can maintain two forms of capital. We have the fixed capital account and we have the floating or fluctuating capital account. So for the fixed capital account, the partner ensures that the amount of their capital is not subject to changes over periods. So thereby, adjustment to capital are being taken to the current account. That means capital belief, their main amount of capital contribution should not be changing over time, should always be fixed. So in that manner, they believe all whatever changes to the capital. What do you think will bring this adjustment to capital? They include the profit of the partnership. When the partnership makes a profit, the profit will be shared among the partner. It should be shared. So share of profit to each partner, interest of capital given, interest on drawing charge, the drawings in the period, all of those adjustments, the partner believe they will change their capital. So they don't want that to change each capital. What will happen? They will not take all of these adjustments to a separate account called current account. So all of these adjustments are to actually be put in current account. So I think this is easy. So whenever we are maintaining a fixed capital account, we will be required to open a separate account called current account to absorb those adjustments, and that's what we will mostly be doing. Is that okay? That is what we'll be doing. So all adjustments in the period will always be included in that arena. So partner maintain this capital account will require opening current capital account as well, the current account in one way or the other. So we also have the fluctuating of floating capital account. So the fluctuation of floating capital account, the capital of the partner change over period as a result of including adjustments to capital account directly to the capital account without opening a separate one, ledger account. That means all adjustments in the period are usually included in the capital account, and therefore what will happen? The capital account will be changing over time. So that is my partnership account. So we have all of these accounts prepared by partnership business. So we have the statement of profit to loss, or also called the income statement. We have the statement of distribution of the income, which we can as well call appropriation account. So we normally call that appropriation account. I think that is just the addition to our supervisor statement, income statement. No, our account. In supervisor financial statement, it just needs to prepare statement of profit or loss. It should be the profit of the business, and as well prepare the statement of financial position. For a partnership, after you prepare the statement of profit or loss or income statement to show the performance or profit of the partnership business, there is always the need to distribute the income of such income or profit of the partnership among the partners. So therefore, we then need to prepare the statement of distribution of the income, which we also call the appropriation account. So after the preparation of such statement, the next to be prepared is partner capital account or partner's current account. So the partner's capital account will be prepared when the partners maintain fluctuating or floating capital account in the explanation of capital maintenance. So when partners maintain floating or fluctuating capital account, we can prepare partner capital account, because why? We just adjust the partner's amount of capital with the adjustment needed. What are the adjustments? The share of profits for which each partner receives. Once we have the share of profits, we adjust the drawings, the interest on drawing, if there is any to be charged. We will adjust interest on capital, any interest on loan in the period also will be adjusted. So that's what I explain the partner's capital account. Now, if at all we now have this capital account, the main account to be paid in this regard is partner current account. Because why? The capital maintenance there for this capital account, that capital is just fixed. If you can open it. If you are opening that, you are just putting balance brought forward in the capital account, and that is all. No adjustment there. So there's another element you need to open that. So what is required to open in the fixed capital account maintenance is the partner's current account. So our partner's current account, it contains the balance of the current account from previous period and all necessary adjustments which are actually mentioned. Although we are going to see the typical example of such an account very soon. So we also have the statement of financial position, which is required to show the position of the partnership business in terms of what is the asset owned by the partnership business, what is who are those that have rights over those assets in terms of the equity of the partners, and as well the liabilities, which is the word owns to outsider. So these are just the accounts that is required to be prepared, or that are required, to be prepared by a partnership business. Again, we are going to prepare the statement of profit or loss or income statement to show the income, performance, net profit or profit for the partnership business. After the creation of such, we also need to prepare statement of distribution of income to distribute the profit of the partnership among the partners. That is what we have to do. Also, the next thing to be done is the appropriation account, which is also the statement of distribution account, rather income statement, statement of distribution of income, rather. So after we prepare that, we now prepare partners' current account. Then we now prepare our statement of financial position. So let's see how this account look like. So our income statement or statement of profit or loss actually includes sales. What is the amount of sales of the business? We will put that there at the extreme edge. Then the cost of sales in the period. So we will say, okay, what is the amount of cost of sales? But cost of sales will not be directly given in most questions. It will be our responsibility to determine that. So how are we going to compute the cost of sales? We will say, what is the opening inventory in the period? We will add purchase, that is the goods that was brought in for this new accounting period. We will add goods that were purchased in the period of bought. After adding that, we will let any amount of goods returned back to the suppliers in the period. We will add carriage inward. Then we would actually we are going to let the return outward in the period. Then after doing that, we will have our cost of goods available for sales. Then we let our closing inventory. Then we have cost of sales. Although we will have some adjustment as well, like goods withdrawn by any of the partners which has not been recorded, or any other adjustment that we have first purchased or goods utilized in the period. We adjust that. Or wages, because wages is to be charged. Wages sometimes, if does not increase salary, is always deemed to be a direct expense. So like it is incurred directly with the amount of goods bought in the period. So we are going to charge that directly as well. So once we then have our cost of sales as in the procedure I actually explained just now, we will let that from our sales. Then we have our gross profit. So once we have the gross profit, any other incomes of the partnership will be added with the gross profit. Then we will not let all expenses and provisions. Expenses are many. Our expenses will include all accruals and it will exclude all prepayments in the period in the expenses. So all accruals are expenses that are incurred in the period but they are not being paid for. It must be paid by the accrual consent. So we will exclude all prepaid expenses in the period. That is how we are going to determine that. So we then consider provisions. All the provisions in the period will also be adjusted for. So once we have our expenses and the provisions, we add them together. Then we let that on our total gross profit and other income. Once we let that, then we have our net profit. That is all about the income statement. The next thing to be considered now is our statement of distribution of income, which we also call appropriation account. So our statement of distribution of income or appropriation account includes the net profit of the partnership business. We will add interest on drawing to that. So assuming we have three partners. The partners are ABC that owns the partnership, ABC. So maybe A and C just withdrew in the period or take drawings in the period. So that amount of that drawings, interest will be charged on it. And one thing about interest on drawing is to discourage partners from withdrawing in the partnership. And let me tell you, accounting for interest on drawing is a discouragement. Like it is a discouragement of the partnership, or the partner rather, and the standard and income to the partnership. So what that is just trying to explain that whenever interest on drawing is charged on partners drawing, method A is to charge that against partner. And once partners are charged, it is an income for the overall partnership. So interest on drawing is always an income for the partnership. That is why it is added to the net profit immediately such is charged. So accounting entry for the sake of OBJ, yes, it's very important that you take this into recognition. Accounting entries for the interest on drawing, I hope you are going to be writing that down, is to debit our partner's current account. That means if it is to be this capital that is maintained, and if it is to be the fluctuating, we are debiting that to the capital account. So either of the two. So we debit that to our current account. We assume we are maintaining this capital account. So we debit that to our current account and we will credit that to our income statement of distribution of income or our appropriation account. And that is if we are crediting that interest on drawing to our appropriation account, that means we are adding it to the net profit. So these two now, A and C, actually withdrew in the period. So we will add that amount of extra charge. We will add that to the net profit because it's an income to the partnership business. Why it's not going to be a charge? Because it's going to be reducing their interest in the partnership. So we also have salary. So any partners that are active, all partners that are active, they need to be paid salary because they are working for the business. They have to be paid salary. They have to be paid salary in one way or the other. So all partners that are active in the world in the partnership must be paid. So any partner pay salaries, the amount of salary that is paid to them, irrespective whether they have been given in cash or they are yet to be given in cash, it will be deducted from the net profit and interest on drawing. So we learn that before getting the profit to be shared. So A and B are active, so they will pay salary. So this is the salary of A, this is the salary of B. When we sum it, will give us this. So we are letting that from the net profit and from the what? From the this thing, from the interest on drawing, so that we can get our profits to be shared. The reason is that partners are working for the business. Their salary does not form the salary of the business that will go to statement of profit or loss. No. Since because of their special nature, any salary paid to the partner in the period should go to the statement of distribution of income. So therefore, partner salaries in the period, the sum will come to this aspect here. Also, we also have interest on capital. Interest on capital, to begin to work with the partners, will also be deducted from the appropriation account. So we will have all partners will have to be given the interest, because interest on capital is an encouragement for partners to retain their capital in the partnership business, and it is a charge. It is a charge against the partnership business. Then we are deducting that here. So interest on capital, accounting entries for it, please do not forget, is to debit the appropriation account here. That means we will deduct and credit the partner capital account. Debit appropriation account and credit the partner capital. The reason for that is that it is a charge against the partnership business. Because we are taking it from the partnership business to give the individual partners. So it will be credited in their account and it will be debited to this appropriation account. Same to apply to salary too. Salary partners that are active, the account entries to debit the appropriation it will debit the appropriation account and credit the partner capital account with salary. But as far as the salary is concerned, the special one, you are going to credit salary to the capital account only to the aspect of the salary in which the partner has not received. How do you know if the partner has received salary or has not received a salary? If you are given a question in your trial balance, any partner salary that is in the trial balance means it's already been paid for. So therefore, it should not be deducted in the partner. It should not be credited in the partner capital, because the partner has already received it in cash. So that interest will not be given again. It should not be credited. If we are together as far as the salary is concerned. But if we now have the information of the partner salary in our additional information, there is no there will be the need to credit that to the partner. That means partners have not received it. So it will be credited to their capital. It will increase the amount of capital in the period as far as salary is concerned. So the case as far as salary is concerned. So that means salary that is in the trial balance will be treated once. And where? In the appropriation account. Salary that will go to the current account will include salary that don't be paid for. That means salary in the additional information of your question will enter into the appropriation account, and it will also enter into the current account. That means entries for salary is that salary in appropriation account is irrespective of whether it has been paid or it has not been paid. All salary paid to partners must come to the appropriation account, whether it has been paid or it has not been paid. Why? Salary that will go to the partner's current account or capital account will be the salary that is yet to be paid to partner. Hope that is well explanatory. So interest on capital, that has also been explained. So the accounting entries, they have the same accounting entry as salary. Interest on capital has the same accounting entry as salary. Actually, the salary is not paid. So the entries to debit the appropriation account and credit the partner's current account. Now, once we now less the salaries and the interest on capital from the net profit and interest on drawing, if we less the two, we have our distributable profit. That means profit to be distributed among partners. And once we do that, we now have distributed profit is the profit to be shared. So we share the profit among ABC in their sharing profit ratio. And we will have that. That is all about this statement of income. The next thing to talk about is the partner's current account. So partner's current account, as stated earlier, shows the interest of partner. Is that okay? Is that their capital? That means if I don't be maintaining this capital account, and most questions will come in this manner. So it will be assumed partners are actually maintaining this capital account in the exam. So I will want us to really prepare. So the balance of each partner's current account will be given is okay from last period will be given. If it's not given, that means they don't have any balance from last period. So you will be given the balance. So this is the balance brought forward. Is that okay? Normally, current account should have a credit balance. That means partners have interest in the partnership. But some partners will have overdrawn their interest. Just like this now, at the beginning of this period now, and see how they have a credit balance in their current account. But what happened? B has a what? Negative balance, which is the debit balance. That means from last period, B has overdrawn the balance in the what? In his statement or in his current what account. So, and that means his balance, that debit balance means his interest in the business is not even up to the capital balance already. So now, next thing now, once we put their balances in the appropriate entry, debit and credit, next is now to debit all the drawings, not instead of drawing, all drawings. Is that okay here? Will be one way or the other. We try to debit the account with to the debit side. There we debit. So this is a drawing. Is that okay? To be debited, as you can see the figure. So interest on drawings will be debited. Is that okay? So I told you earlier that B does not have drawing. It was only what and C that has drawing. So we will debit the statement with the drawing, as you can see. Is that okay? Now interest on drawing too will be debited to the current account because it will reduce. We are told that interest on drawing is an additional charge to the partner, so it will reduce the partner's interest. So drawings and interest on drawing will reduce that, and they will be debited to the current what account. This question is always been asked in our OBJ and short answer question. You don't lose mark. Is that okay? So after you have debited the account now, is that okay? With interest on drawing, you have debited that to the current account and drawings. Next now, the credit side will actually include our salary. So this is the salary after the balance brought forward for A and B has been done. So we will credit the account with salary. So A and B are the one that are active. C does not have salary. You can see this dash. So if we receive salary of this, you put the amount of the salary received. You also credit the account with interest on capital. So I told you it should be credited here because it was withdrawn from the net profit before we distribute that net profit was withdrawn, and it was given to the world to the partner. Now this asterisk is telling us that salary that will come here was the salary that has not been given to partner. Is that okay? Yeah, please don't forget. Now that is the beginning of this asterisk. The salary here must be the salary that has not been given to partner. So interest on capital now, we now include all interest on partner's capital. Is that okay? It will cater to the current account. Now interest on loan. And one thing, the reason why I put asterisk here, that means C has given the partner's loans. Is that okay in the period? So since the C has given the partner's loan and the interest, if the such loan will attract interest, we will say earlier that in a partnership there is no agreement. Such interest on loan with what? In one way or the other, we attract 5% interest. So interest on partner loan, if it has not been paid in cash to the partner, it should be credited with the partner's current account as his interest. So, but the reason for my asterisk here is to actually explain that interest on loan should never be in the corporation account. Although it is an issue among scholars. Why is it an issue among scholars? It's because of the fact that some scholars believe interest on loan is okay, should usually being used to finance the business. So therefore, interest on loan should be in the statement of profit or loss. Think about it. If such a loan is not obtained from the partner, it will be obtained outside, and that such interest will form part of the finance cost for the business, which is an expense for the business. So obtaining loan from the partner means it was obtained outside. So therefore, interest on loan should be in the statement of profit or loss, not appropriation section. Is that okay? The appropriation is to distribute interest, the profit of the partner. So what should be considered should be the salary, interest on drawing should be added, salary should be deducted, interest on capital should be off. Why some still believe no, since interest unknown deals with partner, anything that deals with partnership or the part with partner should not be affect the day-to-day running of the world of the business. Should always be in their profession or segment by belief to the first school of thought. That is why interest unknown here is not in our proportion section. So interest unknown will have come part of the expenses in the payment of profit or loss as shown to you earlier. So that is the reason for my asterisk here. So once we actually debit and we actually credit, by the time we balance the account, we add all credit of A and we add all debit up to the interest on drawing. The difference will give us balance carried out. That means A credit is more than what? A debit. That is why we have balance carried down here on the debit side of what? Of A. Same thing, we have all the credit of what? Of B, which includes salary, interest on capital, is that okay? And the share of profit. And the addition there is more than his daily balance and his wealth. Because he didn't have drawing and interest on drawing, so that helped him. He now has the credit balance. He doesn't withdraw again because he has seen that he has the daily balance of this. In this period, and he will withdraw. So, see now, we add all credit entry of his entry and we less interest drawing and interest on drawing, he's still having the credit balance. And we total the account. So this figure is not both represents the total of both entry, debit and credit, and will bring the balance brought down. I'm sorry I didn't write balance was brought down. So I hope this short video has been able to help us to understand partnership. So the second leg of the video, we actually we'll take examples and we'll do some calculation. Yes, which you will see everything that is being solved. And everything that we've shown here will be fully put into application. So I will teach you guys how we can actually prepare our professional account first, how we can prepare current account, then we will now take a full question whereby we will prepare the income statement and also prepare all of our professional account, current account, and prepare statement of financial position. So expect more from Shining Gate. So take care of yourself. Thank you.